Welcome to the Business of Property podcast. I'm Simon.
And I'm Stuart.
We're both property people running our own businesses. This podcast is just us chatting, as we often do, about anything and everything property. So, Stuart, you were going to talk a bit about how we finance our existing properties or our future properties, or how we finance property.
Yeah.
Where were you wanted to go with that?
Well, you were talking about being an angel investor the last time we had a chat. And I thought a natural thing there, well, we started talking about the fact that they were using a bridging loan. Well, you mentioned that they were taking a bridging loan, but also that you had no security on that property. So it just got me to thinking about how we decide on which mortgage product or borrowing product that we're going to use. Because, so for example, on your portfolio, I'm guessing you have what I would consider standard buy-to-let products, but is that the case?
Mostly. One of my properties used to be the property I lived in. So that's actually got a residential mortgage with a...
consent to let?
That's the word. Thank you. I couldn't think of the word consent for some reason. But yes, consent to let, which they, I think, charged me 50 quid for or something.
Yeah, it's really good if you can do that.
Yep. And yeah, so that's still on that mortgage, although actually that's hasn't got very much longer left on its term, so I'm going to have to change that mortgage at some point, which is a shame because
it is
good interest rate.
I've done that once, and I was just about to say that's the reason it's really good is because, well, generally you can't get further borrowing on a consent to let, but you do get to retain the residential interest rate, i.e. quite a low interest rate versus a buy-to-let product.
Yeah, that mortgage is on I think it's a 1% above base tracker. So it's
1.25?
Very good.
What are we on now? 0.25%?
The base rate's 0.75, is it? Maybe. Well, crikey, I should
let's
know
not
that.
get into that then. It's low.
It's low.
It's low, I think, is the bottom line, isn't it?
Yes.
That's really good, isn't it? Well, under 2% in anyone's money is pretty bloody good, isn't it? You're not going to get under 2% for any borrowing anywhere else, are you?
No, indeed. I'm going to miss that mortgage when I have to replace it.
Yeah. Well, it's good because I didn't even expect us to go here, but you've talked about actually before you even move on to a buy-to-let product, you can actually get a product on residential, which is the consent to let, which it just means they're giving you the right to rent out that property legally.
Yep, indeed. So when I first started renting out that property, I rented it out to lodgers. And I'm not actually sure if I checked with the mortgage company before that, but if I did, I don't think they were too fussed. The consent to let was only when I moved out and started letting it as a whole.
Yeah. So then the others, then I would assume, are on buy-to-lets.
Yes. Yep. Standard buy-to-let mortgages. One more tracker, and others are fixed rate.
Typical loan to value?
Yes, they were when they were first got a sort of 75%-ish sort of mark. Some of them are quite old now. The two tracker ones particularly are the oldest ones, and now the loan to value is much lower than that because the property prices, or property value, should I say, has increased. But yeah, I'm reluctant to remortgage off the nice low interest rates.
Well, it's interesting because you've mentioned tracker. In fact, all of mine, I believe, are fixed rate. Mm-hmm. When did you take yours out?
So the two trackers, the first one was in, oh crikey, it's testing my memory, 2002, I think, and the second one was in, I think wasn't until 2004, I think. So they're old. They are old mortgages.
So they're the same mortgages you've had for 18 plus years?
Those two, yep.
Bloody hell.
Yeah, so in my property investing career, I have not made the most of the capital value of my properties. So if I'd been working them much harder, I would have remortgaged those earlier, extracted more equity, more cash out of them, and gone round again, putting that into new properties. But I had a long period where I got distracted by by a career in IT and building a family.
Yeah.
So they got rather neglected, and now they've been there so long that the interest rates or the base rate has dropped dramatically, and it seems a shame to lose the low trackers.
Well, I don't think it's a bad thing. I think it's actually a good thing. It's just a long time. It's funny how I think you and I are we're complete opposite ends of the spectrum. Because I don't think there's one mortgage I've had for, if I have a fixed rate, and the reason I do fixed rate is just because, a couple of reasons. One is I always need to know when that product's going to expire, and I don't want to have a product that's going to last too long because I don't know what I'm going to do with the property, i.e. I don't know if I'm going to need to offload it. I love to have fixed fixed cost structure, so I kind of so I know what's coming out, and one could argue, well, that could be lower now, and in some cases, I don't doubt that's the case, but actually, I've planned for it.
But also, surely it's got to be because fixed rates are cheapest.
Yeah, and you pay the lowest amount.
Yeah, so, I mean, these days the two trackers I've got are 1% above base and 1.25 above base, I think. But these days, trackers, you don't get...
jealous, I want to throw a chair at you.
you don't get trackers that low anymore. I mean, I think you're looking more at 2% above base, if not more. And of course, if you're looking at standard variable, which is the other option, then that's much, much higher.
Yeah.
So fixed rates are generally speaking, the cheapest option. And as you say, the most predictable, reliable option. So I was interested in you saying you go for fairly short ones. So the most recent remortgage I did, I opted for a 5-year fix. So my reason being that rates are fairly cheap at the moment, and there's lots of political turmoil going on at the moment, and I wanted to sort of see my way through that without having to worry about what effect it might have. So I'm guessing you haven't gone for anything as long as a 5-year fix.
Never. No, it's 3 years maximum for me. I'm sure some of mine are 2 years in terms of the detail. But again, on the topic we're talking about, so you're talking about 75% loan to value, buy-to-let mortgages. Most of mine are HMO mortgages, so house multiple occupation mortgages. And the difference for me is I tend to go for an 85% loan to value product. And hopefully the reasons are obvious on that. It's just less cash in. So obviously we're paying a 15% deposit as opposed to a 25% deposit. However, the difference is we're paying a much higher rate, certainly probably more than double what you're paying on those two properties of yours we're talking about. I think my cheapest will be 4.59%.
Yeah, because not only are you borrowing on HMO mortgages, you're also borrowing in a limited company, I think, aren't you? Which again pushes rates up.
For some of them, yeah. So I've got HMO in both personal and limited company names.
All right.
And it's a good point, actually. I'm not sure there is much of a difference in the ones I've got. But, I mean, I do remember the rates off my head because I've got so many of them. But they start at basically 4.59, 4.79, and then 5.29, depending on the term.
Oh, wow, that's getting really quite pricey.
Yeah, so I've had some that are on 5.29. Again, some of them I've picked because I've got no early redemption charges, so no ERCs. That's important to me if I need to change something quite quickly on some of them. So another consideration for me. But we were talking as well previously about the property you'd invested as an angel investor, and then they were bridging. So and I thought that was quite interesting because I think the reason why you get these things, so I think a standard buy-to-let mortgage just makes sense. That's what you're going to borrow against. For me, it's quite important to get a high leverage because I'm using that capital because I'm trying to build a business quite quick. However, the downside is we don't have the rates that you're getting, and also I'm quite leveraged, which only if the market improves over time, then that gets better.
Yep.
But that's a big risk. But
yeah, the higher the leverage, the higher the amplification of the market effect.
Yeah. For me personally, though, the leverage is less of an issue in a fluctuating market, provided I know I've got people in there. Because provided the rental income is around what it should be, then for me,
Yeah. If property prices fall and you effectively run out of equity in a property,
Yeah.
that only matters if you want to remortgage or if
sell.
you want to sell.
Yeah.
Yeah. So if you're happy holding, then it doesn't matter. Ride it out.
Yeah. And then I have to, for my own sanity, I think, okay, in 5-year chunks. I mean, I can't think past a year in my own planning or life. But as far as property is concerned, I always think I'm not going to consider what I'll do with this property outside of 5 years. It's a 5-year increment. And then that way I don't worry about.
So you're planning your properties 5 years out, but you won't take a 5-year fixed mortgage?
No, because I like to take another I'd like to know that so again, it comes back to the ERCs for me. So if I take a 5-year product, typically, most of them, if I look, let's say within the first 2 years of changing products, you'll pay 3% of the mortgage amount, in the first year. With only, say, 2 years remaining, you might pay 2%. Then with 1 year remaining, it's 1%.
Yep.
That all adds up if you want to change products. And yeah. I'm doing that now. So on one of the properties, it's the 13-bed actually, which is actually 2 properties on 1 freehold. But I think I'm still in around 3% early repayment charge. Why would I consider doing that? Why would I consider changing products? Because I can get a higher loan to value on a different product, which even if I take the ERC fees out, will still give me some money back. And actually the monthly payments will still be a few £100 lower than the current product. And that for me is why.
Improving cash flow.
Improving cash flow and actually putting cash in the bank. And with investors, I kind of need to recycle cash fairly frequently. So that's why I don't ever look at a 5-year fixed product, because it worries me that, okay, if I need to do something, I've just then got more costs at the back end. Yeah.
Yeah, I mean, that makes absolute sense. And I think planning 5 years out is extremely hard. I mean, in my case, I know I'm not going to do anything with the property for 5 years, so it's easy. But where your business is a lot more dynamic, so I think you are sensible to have those options open. So the angel investment that I made recently, or a while ago now, but I'm hopefully getting back, was put together with bridging finance to actually purchase the property and do the refurb. So I've seen sort of the bridging process from afar, but I've never actually been through it myself. But I think you have, Stuart. Have you? Is that right?
I have been through it. I'm about to go through it again.
So how is that? How does that?
Third time, maybe.
Ooh, okay. So excellent. Lots of experience. So what's it like? How's it compare to other financing approaches?
It's more expensive. That's the first point. So you've talked about circa 1.75, 2% interest rate per annum, just to be clear, on a bridge. My limited experience, so I've got a little bit of experience, but is anywhere between 0.64 and 1% per month. In my head, it's always 1% per month. So if we were to model it out, you're paying 12% per annum versus 2% or under. That's the difference. However, obviously, as we know, the bridge is when you're looking for speed. So I first used a bridge when I was buying at auction.
Yep.
And the reason I do that, let's take, I use Kent Reliance a lot, and I'm not going to denigrate them. They've actually been a good bank, which is part of one savings bank. But they will follow a certain level of due diligence, and each bank will be their own. But to even think about being able to buy a property in 28 days would worry me greatly with that bank, and as it would with any other high street bank, to be honest.
Yeah, I mean, I think that's generally accepted as impossible on a standard mortgage.
Yeah. So, bridge lenders, I can think of the main ones, Interbay, Landbay, Shawbrook.
Yeah. Together, I think.
Yes, I've heard of them, but I don't, so, why would we consider bridging? Because of the speed to market. And actually, I think, some bridges can transfer funds within 14 days. So
I think there are other situations where you may have to use a bridge as well. So, for example, if a property is uninhabitable, generally speaking, you can't get a mortgage on that property.
Very good.
So you end up having to look at other finance, and bridging is more flexible on that point, isn't it?
Yeah. And I'm using bridging on another purchase now, purely because I want to get access to the property very, very quickly. So I'm prepared to pay a little bit more just to get access to the property, do what I want to do, and then get the borrowing, very similar to the people you've invested with, to get the standard borrowing and hopefully get all of my money back out of that, including the costs paid. I'm still on a bridge at the moment. Purchased a property in October where that's on a bridge, and that's why I've got 0.64 in my head, because that's what we pay on a monthly basis. Another benefit there, though, is that gets rolled up to the end of the product. So we signed up to that product and actually that's a really good rate, because even if we model that out for the year, for the 12 months, that's whatever that is, just over 7% per annum. We're hoping to sell the property before then, but if I needed to, we'd remortgage that on a standard buy-to-let product. It just gives us that flexibility.
So what's the application process actually like?
Well, I think with a lot of, certainly in the limited company space, and we know a lot of people are migrating over to limited companies, now you'll have to do a little business plan. It sounds grand. Some of them aren't that grand, but the application process is, as you'd expect, for people that are going to assign money. I think the good thing with property, though, is that, the valuation is always key, because that's what they're loaning against. And this is why this conversation started, because you said you didn't have a charge on the property that you'd invested into, and that's because the banks will have that charge. So provided their valuer agrees with your assumptions or your diligence around what you think the property is worth, then they'll provide you with those funds. So the application process I've always found to be fairly straightforward.
Is it very similar to a standard mortgage in that respect? Or standard buy-to-let mortgage, anyway? Well,
I think the difference, the sort of bit I'm alluding to is when you're a limited company, I think you have to do a business plan. So you have to fill out things such as what you're projecting for the year, what your experience is. So that's a big one. They want to know how experienced you are. Again, when you say it out loud, it sounds really straightforward, because why would they give someone money if it's, if it's your very first development or property investment? They're going to be reticent to give you certain funds. So
might at least just be a red flag for them to dig into things a bit more.
Yeah, exactly, and they'll do diligence around your company and your other property, and they'll do but I think they do that in buy-to-let now as well.
Yeah, exactly. I mean, I think buy-to-let from a limited company, you have to put together business plans and sort of portfolio information and things like that as well, don't you?
Yeah. I mean, for me, fortunately, for the last year, maybe two, I've had a presentation that I share with investors anyway, that I now just naturally share with new brokers, new banks. And I think that also helps in terms of confidence, to show that, you have a plan. It identifies what your portfolio is, what your experience is, who your team is. All of these things are quite important before people are going to give you that sort of money.
Yeah, indeed. So apart from getting the answers back faster, the process is really very similar to a standard mortgage. I think the summary I'm hearing.
Yeah, I think it's my experience of it is just a quicker process, which is both exciting and worrying at the same time. You realise. I mean, my first experience was with a large property worth over £500,000, and that's a significant amount of money in anyone's business. And for me, my big learning was actually, even buying with a bridge, you need to take your time, make sure you're making the right decisions, and be clear about how you're getting out of that bridge. You might not know explicitly what you're going to do. I was so impatient to get away from the bridge that I took an incorrect product, and that's just being completely honest. And the product I took wasn't that much. Well, it was better than the bridge, but it wasn't huge amounts better. When I looked at it, it was over 5%. And I look back at that and realised that I should have taken time to make better decisions, but I think I let the time frame.
Do you get time limits on the bridge? As in, do you up front say, I would like this bridge for 6 months or whatever? And
yeah, so they'll do that But most good brokers will always say to you, you know, if you think your project's going to take 4 months, they'll say take at least 6.
Mm-hmm.
So I think, you know, any broker worth his or her salt will say, you know, like, so for this project I'm working on now, I said to the broker, you know, we're going to take 6 to 8 months. And he said, okay, just do a year,
Mm-hmm.
you know, which is going to prove to be about right. So I think...
do you tend to get early repayment charges on bridge loans? Or?
Yeah, so... And it's a good point actually to make, because with a lot of bridges, and again, every bank is different, every deal is different, but you'll always pay an entry fee. So,
Mm-hmm.
you know, figures could be 1%, they could be 2%. So if you're buying a property for £200, £200,000,
if you're buying a Monopoly house,
yeah. You know, so you pay on purchasing the property, and then you also pay on the exit of the bridge. So typically, again, 1%. So they are more expensive, but for the right deals, that will stack up. But it's a good point to make, because you're not just paying the rate, just like you'll pay valuation. So, I mean, you know, without getting into all the details, but you're also going to pay for their solicitor fees. I mean, this is where you realise how banks make money, because you're paying for their solicitors, you're paying for valuations. You know, you're paying a lot of money for these things, all of which gets wrapped up. So all of these things have to be considered when you're going into a deal.
Yeah. So we're kind of out of time, but were there any more finance-related topics or questions or things you particularly wanted to squeeze into this episode?
No, I think you mentioned something about using a bridge when property is uninhabitable, and I just thought there's a really good point there around not paying the additional stamp duty when something's uninhabitable, but I think that could be brought up on another podcast. We'll bring that out a bit just to bring some value to the
Yeah, that sounds like
audience.
a good plan. We can dig into it a bit more on another time.
Cool.
So why don't you tell people where they can find the show notes, Stuart?
They can find the show notes on thebusinessofproperty.com.